Good evening. It's my privilege to be back again and talk about our quarterly results, which we approved at the board meeting a little while ago. Firstly, I'm delighted to share with you all that we had another record-breaking quarter at Reliance Industries with records in both consolidated PBDIT and consolidated net profit, which I'll talk about later. But first, I want to spend a few minutes talking about the macro drop under which we operated. We'll start with oil price, as we all know that this has been a difficult, volatile year in terms of commodity prices. Oil prices in the last quarter averaged about $44 per barrel, down nearly 43% from what we saw a year ago. Gas reference to Henry Hub in the US was at $2.26 per million BTU, down also over 40% from the level of 3.76 a year ago. The rupee at roughly 66 average during the last quarter was 6.6% weaker than a year ago. And slowing growth in emerging markets became almost the central theme in the last quarter. And as the quarter progressed, we saw slower growth from China than anticipated, low or virtually no growth in most of the other large emerging market countries. India at 7.5% met expectations and was the bright spot. In all this difficult, volatile trading environment, two things stood out to our benefit. The first was that we saw a growth in oil demand during 2015 of nearly 1.8 million barrels per day, probably the highest growth rate that we have seen in the last 5 years. Behind this aggregate growth demand was a very strong gasoline trading environment. Demand grew at over 800,000 barrels per day for gasoline around the world, primarily in US, China and India. We saw successive statistics of record automotive sales, record number of kilometers driven by vehicles, and that kept the gasoline markets buoyant during the last quarter. As far as diesel is concerned, demand globally grew by over 600,000 barrels a day, and that was basically in Europe and to some extent in China. Coming close to home, we benefited from strong demand growth across all our 4 major product categories. Diesel demand in India was up 7% year-on-year basis. Gasoline demand in India was up 14% year-on-year basis. Polymer demand was exceptionally strong at 15% year-on-year basis, and polyester demand showed a modest but acceptable growth rate of 4% year-on-year. With this background, let me talk about our financial results, which, as I said earlier, set several records. On the revenue front, entirely due to low commodity prices, we had 24% lower revenues, consolidated at 73,300 crores. PBDIT, on the other hand, was up 24% at 13,800 crores, both due to higher volumes as well as margin expansion, which I will talk about. At the EBIT level, we were up 48% at 9,600 crores. This again is a sort of a record, not just in the absolute amount, but also in terms of its growth year on year. And finally, we had consolidated net profit up 39% at 7,290 crores. We had volume growth, as I said, both in refining, where we processed 18 million tons at 116% capacity utilization, the highest we have ever done. In petrochemicals, a volume growth of nearly 20%, which I will detail later. And finally, as far as margin expansion is concerned, at the RIL level, EBIT margin was 11%, nearly twice of what we had at the same time last year. As far as refining is concerned, we had EBIT margin of 11.3%, again among the highest that we have seen, a full 730 basis points higher than what we saw last year. In petrochemicals, we had an EBIT margin of 13.6%, up nearly 460 basis points from what we saw last year. In upstream, unfortunately, because of the lower commodity price environment, we had a disappointing performance with EBIT down nearly 89%. In retail, we had another successful quarter, set several benchmarks in terms of number of stores, in terms of revenue. Revenue crossed 6,000 crores for the first time in our retail business, and that's a new record with record profits too. And finally, we ended the quarter with a strong balance sheet with over 90,000 crores in cash and cash equivalents, which set us well to a year in which we expect to spend for completion of our projects over the next 12 to 15 months. Let me now talk specifically about our key businesses. As far as refining is concerned, as I said earlier, we had a record volume, record operating rate at 116%. In comparison, while the refining industry did well globally, the average was between 85 to 90% in other geographies. In terms of gross refining margin or GRM, we had a 7-year high of $11.5 per barrel as compared to just $7.3 a barrel a year ago. When we look at individual components of the barrel, clearly the best performing part was gasoline, continued to be strong at $19 per barrel and roughly the same as the previous quarter. Diesel improved significantly by over $3 a barrel to $13.8 a barrel as compared to previous quarter, coming on the back of some seasonality and winter turnarounds. Naphtha, which usually trades as a discount to crude oil, traded on average at a premium of $7 per barrel as strong petrochemical demand acted as a pull to naphtha pricing. As far as crude sourcing is concerned, the Arab Light Arab Heavy differential widened by 50 cents per barrel, helping complex refining. The Brent Dubai differential widened by nearly $2.50 per barrel, which helps refineries in this part of the world which are benchmarked to Dubai. Fuel oil on the other hand strengthened a bit due to higher bunker demand, but all in all it was a good environment for buying crude around the world for complex refiners. As far as our retail operations are concerned, we opened another 150 retail outlets in this quarter, and we now have 750 retail outlets functioning. In our petrochemicals business, we had both margin expansion as well as volume growth. Volume growth came from new capacities in PTA and PET and some debottlenecking in other products. Margin expansion came from polypropylene and PTA, stable in all other products, and some softness in polyethylene compared to previous quarter where it was at a record high. As we look at the margin environment, even though we are seeing strong numbers, these margins still represent 5-year mid-cycle levels and give us the comfort that there is sufficient elbow room for improving margins as the cycle in both our chains gathers momentum in the coming months. I would also say that we saw margin improvement on the back of strong demand growth in India, and as I said earlier, a 15% growth in polymers and 4% growth in polyester helped us make sure that even all our new capacities got sold out and that we were able to get full margins available to any Asian producers and often at a premium to that. Moving on to our oil and gas business, as I said, this business has been directly affected by the lower commodity prices. We had roughly 1700 crores of consolidated revenue, but less than 100 crores of consolidated EBIT in this business. In our shale gas business, we had roughly flat production as compared to previous quarter, but realization on average is lower by 47% over a year, directly impacting the bottom line. In India, we had production of roughly 39 BCFE equivalent, which has been affected by natural ongoing declines. So lower price environment with both lower volumes on a year-on-year basis have impacted the performance of this segment. As far as retail is concerned, we now have over 3,000 stores operating. We added over 160 stores in the previous quarter. We set a new benchmark of over 6,000 crores of revenue in this quarter, and we had a revenue growth in excess of 25%. So all in all, a very satisfactory performance from retail. I would close out by saying that 2016 is anticipated to be a big year for all of us at Reliance. It is the year in which our projects at Jamnagar and other locations come to completion and start up and completion. It is the year in which we expect our digital services digital services initiative to get to the market, and frankly, I really look forward to connecting with you all sometime in April to take you through our annual results and quarterly performance. Thank you.